Our next guest says a deeper pullback could be in store as corporate earnings roll in. Join us with a technical look on the markets. Katie Stockton, founder and managing partner of Fairlead Strategies and a CNBC contributor. Katie, yesterday, Mike Santoli got my attention when he said that, and it was yesterday morning, so we hadn't gone back below 4,100 on the S&P, but he said that some of the overbought conditions that we've seen in previous when we've gotten to this level, which has been a range, but this has been the high end of the range. This time around, it's sort of been there long enough, moving, churning around, that the overbought condition was worked off, which made me think maybe there's more to come in terms of the rally, which, you've been steadfastly thinking that this is range bound and will eventually head back down, maybe not to the October lows, but maybe to the October lows. Anything better for you yet? I always ask you that. One of these days you're going to say, wow, yes, but maybe not today?
Well, we'll start with the good news. And the good news is that the VIX did break down below the support level that we've been watching. And essentially what that means is that the S&P 500 should eventually break out. As you know, we were watching around 41.55 as resistance. And that level should be surmounted. First, we do expect a deeper downdraft. So that's what we're focusing on near term still, especially with resistance having been left intact. And now, as per Mike, we are seeing a reaction to that overbought condition. There's a short-term momentum gauge that a lot of technical analysts use called the daily MACD indicator. It's been one of the best market timing devices over the past year or so, and it just turned down for the S&P 500. It was already pointing lower for the NASDAQ 100, and it suggests that this pullback could stay with us for maybe 2 to 3 weeks at a minimum. So we want to stay on the defense for now. But the chances of a higher low, even versus December, the initial support being around 3,800, are now higher given that VIX breakdown.
Were you, you were probably watching crypto and Bitcoin, because we talked about that last time. It kind of, in your view, had moved above some significant levels, indicating maybe it was at least going to hold those levels, not go back down. I don't know, at one point we were talking about below 20,000 again. It's up 8% today. So it initially backed off to, I think it got low 27,000, maybe below, but now it's back almost to 30,000 just in the blink of an eye.
The volatility is amazing there, isn't it? And we have seen a base breakout from not just Bitcoin, but a lot of the altcoins as well. And that is an intermediate term positive. But we still think that risk is heightened there short term. We're not a buyer. We're certainly not a buyer into an 8% up day. And we say that because there are overbought conditions, and with volatility so high, especially with equities poised to also pull back, to which Bitcoin is positively correlated, we'd give it some room. The former breakout point is around 25,200, so that becomes our initial gauge of support for Bitcoin.
We didn't get to talk about the 10-year and yields enough last time, but I think you said we are still in an uptrend for yields, and if 4% is probably going to happen again on the 10-year, that is very significant, because if it were to stay here, I just don't see any way the Fed can feel that great about what it's doing.
Yeah, I don't disagree. With the yields, we really had to focus on each individual time horizon. Short term, to us, they look a little bit higher. Intermediate term, they look sort of sideways to lower still, but within the context of their long-term uptrend. So it's a matter of reconciling those time frames. We do expect treasuries as an asset class to do better in relative strength terms versus equities. And we've already seen that to some degree, some stabilization in relative performance. So we think they're a very viable asset class at this time, with yields poised to kind of back and fill, move overall somewhat sideways to lower for the next few months. But we see that as a likely sort of digestion of the long-term uptrend, which has support at 3.25 initially.